Welcome to another episode of Millennial Investing Explained. Here's today's question. You recently wrote a piece about how the new free trades that a lot of brokerages are doing aren't truly free. Talk to us about this idea a little more.
Robinhood 2015 came out and they said, hey, we're not going to charge on stock trades, free stock trades for everybody. And I remember going and talking on college campuses and saying, you guys, you know that's not free, right? And they're like, what? No, I don't have to pay anything. And recently, Charles Schwab and TD Ameritrade and E-Trade all got rid of their trade commissions for stocks and ETFs. And in reality, the costs that I was highlighting in that piece, those have always been there, but like it's never free. And my feeling is if you're not paying something, then you have just become the product. You know, they are now selling something of yours. And it's kind of like the internet. You know, you go and use Facebook. Facebook isn't the product. You, the user, are the product. They are selling your data. They are marketing to you. With trading, there are a number of explicit costs. So commissions would have been one of them. But the implicit costs that are there are quite large. So there's something called a bid-ask spread, where if you go to Google Finance or Yahoo Finance, you'll find the stock, the current price, and you'll see two prices divided by like a slash sign. And that's the bid-ask price. And basically, you know, if you were going to buy a share of a stock for $100, the ask might be $100.05. And so that means it costs you 0.05% to make that trade. Now, you might say, oh, it's just 5 cents. But if you're trading $1,000 worth, well, suddenly it's not. And for a lot of mutual funds, you can buy the entire US stock market and the expense of the fund is 0.03%. So this is nearly double what it costs to just own a fund. So these bid-ask spreads, when you trade, it's really the cost of the market maker executing the trade on your behalf. The other thing is that these custodians, the Schwabs, the TD Ameritrades, the Robinhoods, they sell your orders to high-frequency traders. So if anyone has read about high-frequency traders, they just trade and make fractions of a penny on each share that they trade, but they need orders to be able to do it. And so they pay the brokerages for your trade, and you know that's how they make money. Another piece is sometimes it used to be like they'll have platforms where you see, it's kind of like at a grocery store, mutual fund companies and ETFs, they pay for shelf space at custodians so that you see their funds first if you're going to trade. So that's a piece of it. But I think one of the biggest ways that these places are making money is on your cash. So Charles Schwab, for example, nearly 60% of the entire company's revenue came from cash. So like they pay you basically nothing. Then they go and lend the money for say 2%. And so they just pocket 2%, plus they charge you money. And you know, ultimately, I could probably go down another half dozen, but they start becoming more opaque. Really, in reality, free trades should not be the reason that you choose a provider at this point. I mean, it used to be that when Charles Schwab launched, I think a discount brokerage trade was like $80. So yeah, it's obviously a lot better than that. But free trades also might encourage you to trade a lot. And if you trade a lot, you're going to make mistakes. I mean, there's a lot of research. The more you trade, the worse off your returns are. And men tend to do that more than women. I mean, the research is pretty clear that men are overconfident, they trade more, they have worse returns. So I would say that don't let the free tempt you into making some of these bad investment choices or sway sort of where you keep your money to invest.
I know you aren't generally picking individual stocks anymore, Peter, and I completely agree with everything you said about the free trades. But one of the hidden benefits that I think maybe not a lot of people are considering is something that I plan on doing a lot and that I've already started doing is I had a huge watch list of stocks that I really wanted to start researching more. But because I had no skin in the game, I didn't make time to actually go in and research those companies. So now with no commissions, I'm able to just buy one or maybe two shares to get those stocks in my portfolio. And now I have some skin in the game. And now I have a reason to go in and learn more about those companies and actually put forth the time and effort to research whether I should make those positions bigger in my portfolio. And I know that the commission was only $5 before, which isn't huge by itself, but when you're only buying one or two stocks, if that's maybe a $30, $40, $50 stock, you're looking at 10% or more of your position that you're starting. So it can be large. So for me personally, I like to be able to add these few stocks to my portfolio with just one or two shares, get them on my radar, and then dive into them a little bit more and see if I want to enlarge that position in my portfolio.
Yeah, I think that's a good point. and you mentioned this yourself, it's not your whole portfolio of stocks, individual stocks. And the people who we work with who insist on having individual stocks, it's usually because they're passionate about investing. And, I look at that more as a form of entertainment. And so I would agree, because back when I was buying individual stocks and I was a stock analyst, I remember thinking, well, if I don't buy 50 shares, like it's not worth the commission. And to be able to buy one or two and scratch that itch and kind of have the, expressing of your passion be a little bit cheaper. Yeah, honestly, I'd never thought about that, but that's a pretty good point.
Yeah, and even to your point, maybe now instead of buying 50 shares, just to, like you said, to scratch the itch, now you can just buy a couple shares and you're like, oh, I picked individual stocks, and then if it goes to zero or it doesn't do as good as the market, it's not that big of a deal because you didn't buy that many shares. So I definitely agree it's not necessarily as great as the news makes it seem, but I think there are some hidden benefits as well as there is hidden cons.
Yeah, I think for the most part, as long as people recognize that nothing in life is ever free, that they're always making money off you. And I think some of these costs I mentioned, if they go up, then you're just paying them in a different way. And there is some suspicion that they might go up, but there's no proof of that. So we'll see. I mean, I think the trades was such a small piece of revenue for these big people anyways. I assume it'll be business as usual, but maybe it'll encourage people who are using mutual funds before to switch to ETFs, because mutual funds still cost money and ETFs are more tax efficient. So maybe it's a boon to them, but it's always hard to tell these things and they evolve over time. And I'm sure there'll be more news coming from somebody about something that could shift it even a little bit more.
That's the big caveat there, right? Nothing in life is free. So time will tell. Time will tell. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.